Okay, and then actually let Joe in. I just see that he logged in. Okay, so I will go ahead and call the February 14th Coachella Valley Water District Board Finance Committee meeting to order, 10 o'clock, and I will note that Director Aguilar and Vice President Estrada are present, along with our General Manager, Jim Barrett, Director of Finance, Jeffrey Keel, and our Controller, Carrie Swain, as well as myself, Clerk of the Board. We'll ask if there's any public comments. Anybody wishing to speak on any of the matters on the agenda? We have no attendees, so I will say that is a no. And the first item of discussion on the agenda is the investment performance presentation by Mia Corral and Jason Smith.
Yes, let me just start by introducing Jason again. He's our portfolio manager extraordinaire for Chandler. And he's got higher duties, but he still is our portfolio manager. He's also going to follow up his brief presentation of performance with a review of investment policy recommendations. And then once we're done, we're going to flip to Joseph Federico from PFM is also here. He's also excellent with what he does for our OPEB portfolio. He'll review the OPEB results as well as some recommended changes for the OPEB investment policy. And with that, I'll switch it back to Jason and mention that I'm still suffering with a cough, so I'm going to put myself on mute and try to talk as little as possible.
All right, great. Thanks, Jeff. I'll share my screen. Let me get the presentation up for us. All right, can everybody see that? Let me see if
Yes, I can.
Yeah.
Yes, I can.
All right. Let me see if I can put that in slideshow view here. There we go. All right. So I'm not going to take up too much of your time. There's other things on the agenda here, but just wanted to give you a brief update on what's going on with the district's investment portfolio. And so if we think about what's going on in the economy today, the economy continues to grow. We do have some geopolitical concerns that we're all kind of watching on the news, over the past, month or so, and we'll see what happens there. But just in general, we continue to see the economy grow. The expectation is that the economy will continue to grow here in the United States. With that backdrop, what we really have seen is that the Federal Reserve has become more active. What we have is elevated inflation rates, some of those having to do with some of the supply chain issues that have been going on in the economy. Others are just looking at housing and things like that. We're starting to see rents and things like that percolate up here. And with that backdrop, the Federal Reserve is likely to raise interest rates by at least 25 basis points at its meeting in March. The market is expecting more rate increases. Our view is that we'll probably have at least 4 rate hikes by the end of the year. But the Fed is definitely not on a preset path for policy, meaning that the Fed is going to continue to look at the economy and make adjustments where it sees fit. The other piece that the Federal Reserve is looking at is, in the past, we had spoken about the Federal Reserve buying about $120 billion per month in U.S. government securities, whether that be U.S. Treasury securities or mortgage-backed securities. That program will actually wind down earlier than expected. The first expectation is that we would see that wind down in the summer, but actually by March, we will actually see that wind down. So the Fed is definitely becoming more aggressive as far as its overall monetary policy by increasing rates and also stopping those purchases earlier than it otherwise would have. This is really related to the inflation that's been we've been seeing and realizing in our own lives. And so we'll talk about that a little bit later, but that's what the Federal Reserve has been doing. In reaction to that, what we've seen is that interest rates have really gone up more recently. And so we saw in January, the 2-year Treasury note went up around 45 basis points, up to about 1.18%. So we've really seen interest rates, especially on the shorter end of the yield curve, start to go up in reaction to what the Federal Reserve is doing today. As we move forward, you can see the employment situation on the left-hand side here. You can see this is non-farm payrolls, and on the right-hand side, you can see this is the unemployment rate. The dark green line there is the headline unemployment rate, and the dashed line there is the underemployment rate. And really, what you're looking at here is the labor market continues to be tight. We continue to see jobs created, and also we continue to see the unemployment rate go down. Actually, the most recent number right here, we're talking about December, but the most recent number was above expectations as far as the number of jobs being created. So we are definitely seeing where the economy continues to move forward, and also the labor market remains relatively tight. And then looking at gross domestic product. And so what you can see there is really, if you look on the left-hand side here, you can see the components of GDP, and then also you can see the graph of GDP at the same time. And that maroon line there is the year-over-year change, and you can see that the bars there are the quarter-over-quarter changes. So you can see that the economy continues to do well, especially if you look at the fourth quarter of 2021. You can definitely see how that has been moving too. Then you can look at bond yields. And so you can see that looking at bond yields, you can see the dotted line there is the 2-year, the dashed line there is the 5-year, and the green line there is the 10-year. And you can see also with the yield curve, this is on the left-hand side, on the right-hand side, I'm sorry, you can see how interest rates have moved up with the dotted line being from January, the dashed line being from October, and the most recent from the January 2022. You can see what's looking at, you can see that what is going on there with the overall yield. So you can see that yields have been percolating up. What does that mean to your portfolio? Well, in the short term, there's a little bit of pain in the sense that existing securities that we own today, they typically decline in value slightly as interest rates move higher. But on the flip side of the equation, as interest rates move higher, remember that your portfolio, approximately 30 to 40% of it will mature off within 1 year. And with that, you'll be able to reinvest into that higher interest rate environment and potentially get higher earnings for your portfolio than you otherwise would have thought maybe a few months ago. And so it's really kind of one of those things where there's two sides to this coin. One being kind of a short-term nature where you experience some pain as far as looking at the valuations of those securities, but on a longer-term basis, you're going to get some increased earnings from the portfolio. Here you can see the periodic table of returns. I'm not going to go too much into this. Just remember that this is looking at the last 10 years, and it's looking at asset classes ranked highest to lowest. And you can see most recently, if you look back in 2021, U.S. real estate and stocks and things like that were doing best. And then when you look at some of those other categories, but there were very few negative categories. So in general, over 2021, the markets were relatively healthy over that period of time.
I'd just like to mention here on that slide, this is notes a primary difference between the two portfolios. The OPEB portfolio does have the opportunity to go into equities. And so those small cap stocks, mid cap stocks, unlike the larger portfolio managed by Chandler, we're prohibited from being in equities.
All right. Thank you, Jeff. And then moving forward on page 10, what are the objectives? Safety, liquidity, finally return. It's looking at earning a market rate of return that's above that or equal to the benchmark over long periods of time. And then invest in high quality, as Jeff said before, fixed income securities, i.e. bonds that conform with your investment policy and also California government code. Here you can see the compliance. You can see that your portfolio fully complies with the investment policy and California government code. And then looking at the portfolio, and we're looking at December 31st, here you can see your portfolio versus that of the benchmark. And so in the middle column there is your portfolio as of December 31st. Your portfolio was about a 2-year average maturity. The average duration is 1.82. The purchase yield is 0.95. The market yield is 0.75. It's a AA rated portfolio, and the portfolio is approximately $372.6 million.
Jason, this is
Yes.
John. Hi, can you go back? So I had a question. So on 13, on the yield. There you go. So so you see where it says average market yield portfolio in the middle column, 0.75%. But then the total market value is less than the portfolio was in September. So how does the market yield number, how is that higher, but then the value is less? How does that work?
Sure. So if that's focus on 930 real quick. And if you look at the market yield there, it's 0.35%.
Mhm.
And then the portfolio is approximately $374.5 million.
Mhm.
What happened is that interest rates increased. And so if you look at that in this period of time for the portfolio, it increased around 30 basis, about 40 basis points or 0.40%. And so when rates increase, your existing securities that you have in the portfolio will decline in value. And that's why you're seeing that number go from 374 million down to around $373 million.
No,
Because you're seeing that decline.
okay, all right, thank you.
Jason, you might also want to comment on the nature of the portfolio not being stagnant.
Yes.
When we are in our midst of doing pretty large payments on our capital programs,
Mhm.
have some rather sudden draws in the portfolio to pay for bills.
Yes. And so the portfolio is always looking for opportunities. Also, if you think about the strategy, if you think about the decline in value, those are unrealized, meaning that we haven't sold those securities. So as we continue to hold those securities and those securities mature off, definitely they'll be reinvested back into the new interest rate environment.
Thank you.
Then looking at the sector distribution. And so I'm just going to focus in on December here. And so US Treasury is about 30%, Super National is about 3.3%. You can see certificates of deposit about 3.4%. The money market is always a very small percentage, about 0.4%. You can see corporates around 19.8%. CMOs or collateralized mortgage obligations are about 4.7%. You can see agencies are 30% and asset-based securities are about 8.7% of the portfolio. So well-diversified portfolio within the constraints that we have of the investment policy as far as the different types of securities that we can invest in. Also, the difference between this portfolio and also the OPEB portfolio is these are all fixed income securities, like we said before. Then you can see the different issuers there. So you can see that US government still makes up the largest percentage, almost 30%. Then you can see its agencies make up big percentages there. And then as you go further down the portfolio, you can see all the different issuers that are there. And you can see that there's no position that's larger than 2% in that portfolio. And then you can see the next page there. And then finally it ends there. So well-diversified portfolio. You can see the total returns of the portfolio. And so basically put that against a couple of different benchmarks. And so you can see that your portfolio is in the green, the benchmark's that of the gray. And you can see that if you look on the table below there, you can see your total return on the portfolio. Remember that total return includes the interest plus any realized or unrealized gains and losses. And so when you look at the total return over the last 3 months, even though we've had a decent rise in interest rates, down less than 1%, about 50 basis points. Did better than the benchmark. The benchmark was actually down 54 basis points. And then you can see Leif, who's a very short portfolio, was up 5 basis points. And then when you look over the last 12 months, down around 49 basis points. Still doing better than benchmark, which was down around 50 basis points. And then right below there, you can see Leif, which actually was up 29 basis points. But when you go out to 2 years, and remember that the district has a longer term strategy. And when you look at that versus its benchmark, it's definitely doing better. So there you start to turn positive, 1.42%, 1.37%, and then 0.73% for Leif. And the reason being is Leif is a shorter term portfolio, so it's less affected when interest rates rise, but also you don't get the benefits of investing further out, i.e. getting a higher yield on those securities. And then when you look since inception, 1.52, 1.45, and then 0.84%. As we move forward from there, here you can see just looking at the activity. And so you can see the activity that was happening. There's about $45.5 million in purchases, around $39.1 million in sales in the portfolio over that period of time. And then looking at just some of the supplemental information.
Jason, sorry, I have another question. Can you go back? So
Yes.
I'm just curious. So we have a portfolio that's worth, I don't know, 370 something million, but our purchases are only like 45 and our sales only 39. Is that because the other money is tied up and then also we're using that for cash?
Yes. Yeah, so we have longer term securities. So those securities aren't maturing off over that period of time. And so we have a longer term strategy, average 2 years. So we're
Mhm.
really not basically turning over the portfolio all the time. When you're looking at it, we're doing any kind of purchases for the portfolio. We're doing those based upon an economic basis, meaning that we're finding better opportunities if we're going to sell a security. And also when we're purchasing securities, some of that has to do with potentially new money coming into the portfolio. It can also mean there's a maturity in the portfolio where we're reinvesting those proceeds, or we're doing a sale of a security in order to purchase a security where there's better opportunities.
Okay, I got it. Thank you.
All right. And here's some supplemental information. You can see the average quality there. You can see the average duration distribution of the portfolio. And then I'm not going to go through all the holdings, but I'll page through these very quickly and I can answer any questions you may have. These are asset-backed securities. Then you have the agency securities right below that. And you have the collateralized mortgage obligations, the corporate notes, and then you can see the money market fund, negotiable CDs, supranational securities, and then US Treasury securities. And then you can see some of the transactions that were made in the portfolio over that period of time. Notice that some of the purchases being made today are closer to 1%. And so we haven't seen that yield level in a while. And so that should be additive to the overall earnings as we continue to manage this portfolio. And here's some more economic information. I'm just going to page through that. And from here, I can answer any questions you may have on this presentation.
I'm good.
Okay. Would you like to talk about the investment policy?
Yes, let's go ahead and do that now, Jason.
Perfect. So I will bring that up. All right, so you can see we reviewed the investment policy. Remember that this is the investment policy for the operating reserves. So this is not like the OPEB policy, which you can buy stocks and other types of asset classes. This is more narrowly focused. Remember that it has to be in conjunction or adhere to California Government Code. And so with that, we have the following recommendations for this. And so one of the things, remember that, like I said before, you maintain two investment policies, one for the operating reserves and one for the OPEB. And the one that we're describing here is where the bulk of the money is, i.e. the operating reserve portion of that. And that really was about $373 million as of December. And so there's been some recent changes to California Government Code. And so we wanted to have a few recommendations for the policy. And so the first is that we're looking to basically was SB 998 or Senate Bill 998. And so what Senate Bill 998 did is a couple of different things. The first thing it did is it prohibits more than 10% per issuer in commercial paper or medium-term notes. And so the district's policy already had a limitation of 5%. So we have no recommendations related to that. And then the other recommendation was, per the changes in code, is that they are allowing about up to 40% in commercial paper out to 2026. And we don't think that we need to do that in the policy. We have never seen where the policy has come close to the 25% maximum, and don't see that there's any really need to increase that. So we do not recommend that the district adopt that portion of it. And then also part of that was in the California Government Code, you used to not be able to buy securities that were at zero or negative interest accruals. And so what the legislature did is they looked at that relative to other places around the world where there were negative rates that were potentially out there and wanted to have avenues for the different local agencies. And so they were allowing basically the purchase of government securities out with negative yields or negative interest accruals out to January 1st, 2026. And so, so within that, We don't feel it's real necessary at this point to do that. And the reason that we believe that is if you look at the world today, we are not at negative rates. Even some of those countries that were at negative rates in Europe and things like that are no longer there. So we don't think it's necessarily appropriate to have that language at this point in time, given where we are in the cycle. And then also within the diversification section, we are recommending the addition of money market funds to the list of not to exceed, so that basically we can have more than 5% in the money market fund. The reason being is sometimes you will see where cash is put into the account. It might bring it above that for a short period of time. And one of the things about a money market fund too is it already has built-in liquidity, meaning it has lots of different securities that are in there. And so we're asking for that piece as far as to be able to have that in there. And then also looking at, the 20% as far as looking at that. And so the 20% is already consistent with the current California government code. So we're not asking any changes for the overall percentage, just for that 5% to be added to those list of securities where we can purchase above 5%.
So as board members know, we don't have any action items on the finance committee, but we would be looking for basically a head nod. If you're comfortable with these changes, we would be bringing these to the full board at a future meeting.
Yeah, I don't have an issue. Is Director Estrada on? I can't see.
Yeah, I'm here.
Okay. Hi, I want to make sure you're there.
Yeah, I'm here.
This is a little confusing to me, and Jason, I'm sure you can help me with this. But is it money market fund not considered commercial paper or medium-term notes?
It is not.
Why we wouldn't approve the 10% if that cap has been increased?
Yes. So the money market fund is not considered a commercial paper or corporate notes as far as California government code is concerned. It is really its own category, and so it is not considered to be that.
Okay. And then my only other question or comment is why wouldn't we go ahead and adopt these proposed increases, even though we may not be exercising them, in case at some point in the future we may want to somehow, do a transaction under them in the event that they may be terminated at some point by the legislature and we will have not acted. I'm willing to support the recommendation, but I'm just curious why we wouldn't do it.
So our thought so let's take them kind of one at a time. So if we think about the commercial paper side of the equation, increasing that from 25 to 40%, the district has never come close to that. And given that it has not come close to that, we don't think that is really necessary in order to facilitate the investment strategy to move that higher. We think that being more conservative at this point, especially something that is likely to sunset in 2026, unless there's additional legislation, is not necessarily material enough to want to make a change. And then when we look at negatively yielding securities, things like that, given the environment that we're in today, meaning that we have positive yields and we have a lot of opportunities out there, we don't think that it's appropriate to put that language in there in this case, just in case you have someone that would go forth and buy some negatively yielded securities in the market, even though there were other opportunities that were out there.
I see.
And so our viewpoint is if we got into that environment, we would come back to the governing body and ask for some sort of emergency measure if we were to get back to that environment.
Yeah, that makes sense. Okay. I don't have any other questions, and I think this is fine.
I think it's fine also. Thank you.
Okay, well, thank you. Or if there are no further questions for Jason, I'm pausing a bit. We'll switch over to Joseph Federico from PFM for the OPEB portfolio.
Okay,
you,
great.
Jason.
Can everybody hear me okay?
Yes.
Yes.
Great. And thank you, Jason, for the presentation and the economic overview as well. So I'm going to go ahead and try to share my screen here. Let me know when you can see the presentation. Is that popped up correctly? Can you guys see that?
Yes.
Okay, great. All right, well, thank you all for having me here. Just as a brief introduction, I work very closely with Ellen Clark, probably more familiar with her working with the OPEB. However, I've actually been at PFM for close to 10 years now. I started out of our Philadelphia headquarter office and then came out to San Francisco office about 6 years ago. And I've actually been working with the account quite intimately. I just haven't been to the board meetings yet. So diving into the presentation here, we're showing index performance as of December 31st, 2021. Things have shifted quite significantly since the end of the year, but for the purposes of this presentation, I'm just going to focus on the numbers we have here and provide a little update later in the presentation. So taking a quick look here at the domestic equity indices we're showing, I'm going to focus on the Russell 3000 index. So for the quarter, almost nine and a quarter for the fourth quarter. So very strong performance, and even looking back on the 1 year number, north of 25%. So yes, the OPEB trust does have the luxury of being able to invest in equities, and we've actually, it's seen quite an appreciation in terms of market value over the course of the past couple of years due to the allocations that we've had in domestic and international equity. And then taking a look at international equity, a little bit different story. I'm going to focus here on the MSCI ACX US Net. That's a mouthful. Has lagged domestic stocks quite significantly. So it's coming in at about 1.8%. And then in the 1 year period, it's about 7.8%. So still very strong performance on the 1 year number and north of really what we are expecting going forward, but not quite keeping up with domestic equity markets. Taking a look at alternatives, you do have a small allocations to real estate and commodities. So let's just take a quick look there. We typically don't. Those are more strategic allocations that we will add to the portfolio as we see fit, given the market situation. But as you can see, this NAIR REIT Equity REIT Index, north of 43% for the 1 year number. We actually allocated, I think, about 3% to the portfolio towards the end of last March, if I remember correctly. So we didn't get to this entire number, but it's been a very strong contributor to the portfolio over the course of the year, albeit just a 3.5%. And then similarly, we've actually added to commodities as well. So didn't quite keep up on the 1 year number, but it's actually been one of the few asset classes that's remained positive on a year-to-date basis. So this has actually been another additive piece of the portfolio that we've added over the course of the past year. Conversely, if you look at fixed income, I'm just going to focus on the Bloomberg Barclay US aggregate, flat on the quarter, 0.01%, but negative on a 1 year number. Jason walked us through the mechanics of really what's going on in the fixed income markets. So I don't need to harp on that too much, but we have been allocating away from the fixed income side of the portfolio and reallocating towards these other asset classes I mentioned, such as commodities, real estate, and then having a little bit of an overweight or a tilt towards domestic equity or international equity. So this is just a quick snapshot we're showing here. So this is the S&P 500 index over the trailing period. But these dots you're seeing here represent the tactical decisions we've made within the portfolio over the past, call it 5 or 6 months. So these are just key decisions that we've made since the beginning of the quarter, fourth quarter that is. And then I've also updated it to include the 2 additional changes we made on a year-to-date basis. So just to focus on the most recent one we've made in February. So just at the beginning of the month, we actually took the opportunity to rebalance the portfolio back to its strategic overweight targets. So we saw a little bit of a sell-off coming into the year. Well, a little bit of an understatement. We saw a sell-off coming into the year, and we took the opportunity to reallocate back. So essentially buying the dip, for lack of a better term, and reallocating back to targets. And we have conviction that the stock market will actually rebound and continue to perform better than the fixed income side of the portfolio going forward. Additionally, we made another allocation to a floating rate income fund within the fixed income side of the portfolio. And then we swapped out an emerging market ETF, which was passively managed, so just broadly following the index, with an actively managed allocation, which will actually have a more targeted exposure to corporates and below investment grade
What does
securities.
managed mean?
Pardon?
What does passively managed mean?
So thank you for the question. So a passively managed fund will try and just track an index. So like replicating the entire segment of the market. Whereas when you have an actively managed account, they're making strategic decisions to purchase certain securities within the broader index. So
Thank you.
instead of buying 500 securities to match every security that's in the index, maybe they're only buying 10, as an example. And they
Okay.
have conviction based on their research that those are going to outperform. So you're typically, the costs associated with actively managed funds are slightly higher and can be drastically higher, but we think that there's going to be an opportunity to outperform the market in those situations.
Thank you.
Sure. So this is just a portfolio update as of the end of the year. So as of December 31st, this is how the portfolio was positioned. So this red shows the 12% underweight we have on the fixed income side of the portfolio. So instead of being at target 40%, we're actually sitting at about 28%. And we've reallocated to other segments of the market. So we have about 2% overweight to domestic equity, a 1% overweight to international equity. And then additionally, we have a 5% allocation to other growth. So that's the real estate component in conjunction with an allocation we have to convertibles. And then we have a 2% allocation to other income and a 2% allocation to real return, which is the commodity allocation. And then we hold a 1% just to cash equivalents, which would be a money market fund. So coming back to the top of the page, you can see the portfolio is valued at a little bit about $36.5 million as of the end of the year. Very strong performance on a one-year basis. So in the entire 2021, portfolio earned 12.7% compared to the benchmark at about 10.6. So that's pretty significant outperformance north of 2% relative to the benchmark. And that's really just a product of maintaining this underweight to fixed income over the course of the year, and additionally adding that to other parts of the market. But looking back through longer periods, you can see that it's pretty consistent outperformance all the way back through since inception. So we've been managing the OPEB since August of 2016. And on a since inception basis, we're annualizing about 10.8% versus the blended benchmark, just shy of 10%. And then lastly, this is just a snapshot of our investment strategy overview. So our current outlook is represented by the dark dot, and then the white dot is what we were thinking a quarter ago, so at the end of September. And you can see how they've changed in some instances. So we're actually feeling slightly more positive on international equities, which is right here, slightly more positive on US equities, and otherwise pretty much unchanged. So we will have some investment policy discussion at a later point in this meeting, but I just want to point your attention to the fact that we're feeling positive on real estate, private equity, and private debt. So private debt is something we're going to try to include into the portfolio, at least in the investment policy, so we have the option to do that later, because we do think that's a segment of the market that will be able to serve the portfolio well. And with that, I will open it up to questions if there are any.
I don't have any questions, Vice President Estrada, but I did want to point out, and I might have missed it in your presentation, that the slide 25 that I think is your slide, which shows the return on investment in dollars for the quarter and then for the year, I found really helpful.
Okay.
It really simplifies the game. And I mean, you know, I can see your percentages, but to see it on a cash basis, I think really helps.
Okay, so if I'm remembering correctly, I don't have that in front of me, but is that the account reconciliation page? So it'll show the quarter,
Yeah.
the
Yeah.
net flows. Okay,
Yeah.
So looking at that 1 year number is actually can be very helpful just to understand, you know, what's coming into the portfolio, what's coming out of the portfolio, and then what your return is in dollars as well.
Yeah.
So,
It was really, really useful. So thank you for that.
of course.
I don't have any other questions. Thank you.
Okay, let's move on to the the policy recommendations?
Sure. So this will be pretty brief. I just put together a quick slide here to outline the 3 changes that we were proposing. So the first of which is just is changing the verbiage essentially to capture a broader set of investment options, whether it be diversified type of hedge funds. Secondly, this is probably the most important, and I spoke to it a little bit earlier, but the inclusion of private debt. So we're just going to clearly classify and define private debt within the policy. And its intention is to just be a little bit more prescriptive so that it will allow us to invest in private debt going forward, should we find an opportunity that the board would be interested in. And then lastly, it's just a consolidation of real estate and inflation hedge sections to consolidate it into one section under real assets.
So what is an example of a private debt instrument?
So private debt, as opposed to going out to the fixed income markets and buying like a corporate bond, it's like private equity, except these deals are done and they're not publicly traded companies. So for example, think of like Uber, for example, before they were on the stock market and became a public company. So it might be a smaller company that's still private, and they're orchestrating different deals with these type of firms that we're investment managers that we're working with. So before getting invested in any type of private debt instruments, we would have an education session of sorts to kind of make sure you guys have a very clear understanding of the type of investments we'll be making in that asset class, as well as presenting the different options that we have available.
Yeah, I think that's a great idea, because I know that that's got to suggest potential increased risk, but I think, proceeding with the recommendation is good, but I like your caveat.
Yeah, so I mean, we've been adding, I have a couple other clients that are invested in some of the private debt funds that we already have approved. And it's just been over the course of the past year, but it's essentially, since fixed income markets have been so challenged over the past couple of years, this introduces a slightly riskier version of debt. So instead of getting, a 3%, you're looking closer to like a 7%.
Okay.
And these are going to be small allocations. So it might be 2% of the portfolio.
Okay, thank you. I'm good with this.
Great.
Vice President Estrada?
Oh, I'm good. I don't have questions, but I do just want to agree with Director Aguilar that I think the way that Joe is presenting the numbers, even taking the time to explain some of these words and terminology, it's really helpful for me.
And I also want to mention, so you have attached in your packet the red line version, the change in this policy. It has not significantly been updated for quite some time. And on page 7, it's got a lot of red words there. And as Joseph explained, it's mostly combining and replacing older language to more standard language. Wanted to make sure there weren't any concerns about any of that. And also, I'll just mention at the very end, this is an old format, and it mentions approval by a finance committee chair. As I stated before, as you know, the finance committee really doesn't act on anything, so that page needs to be removed. What we would be doing is taking both of these policies to the full board at an upcoming meeting for acceptance, probably on the consent calendar. And we would make note that Finance Committee had an opportunity to do a more deeper review of the policy at the latest Finance Committee meeting.
Yeah, and I'll just thank you for that, Jeff. I'll just say that it was good to hear about the limitations that we have with the Chandler and where we can move money around. That was new to me. So the more that you could kind of give us details on, I think it really helps at least me understand kind of the broader picture. Because I was looking at that table, what do you call it? What do you call
Yeah,
that table? Like the
Periodic
chemistry-
one?
Yeah, the periodic table, but there's things in there that we can't move our money into, but we could do it on this one.
Mhm.
There was some stuff in there about large caps, mid cap, large, small, and I think, Joe, you kind of broke it down on your presentation as to what that is, and I think you're calling them equities. So all that is is very helpful.
Well, and I also know that there's been questions raised about, why don't we present these results quarterly to the full board? We could certainly do that, but as my understanding is from our board president, as well as my experience from past elected officials that I've dealt with, there isn't a lot of desire to have that kind of presentation made on the regular basis. And that's why we do have to format here where we use this committee as the main forum for reviewing investment results on a regular basis. Not to say that it takes away from any obligation for board members are not on this committee, but it really just becomes so much detail. It's hard to do it on a regular basis. And I will say to Vice President Estrada's comment, we will be careful to articulate some of the differences between the two portfolios in the staff report BAI when we bring this back to help highlight the issue. These are two very different portfolios, and they have two very different investment policies guiding them.
Jeff, when was the last time we went to the board for a full?
On the policy or the portfolio?
No, just on a presentation on a performance basis and an overall update.
We haven't done it since I've been here.
Yeah, I think we should probably do it, at least once a year to kind of get a snapshot of how we performed on a yearly basis at minimum. I'm even open to
We
doing it.
can do that, yes.
Yeah, or even doing it every 6 months. But I think at least once a year, just to get a sense of how we did at the end of the year, I think would be a good thing.
Yeah, I totally agree with you, Vice President.
Well, then we can either agree to do it in January for the end of the calendar year, or we can do it in July for the end of the fiscal year. Which would you prefer?
Well, we're kind of on a fiscal year, right? So
We are, except for
We
tax
are, but-
purposes.
But we're rolling through on a quarterly basis for this. So I think we would be comfortable with doing it in an upcoming meeting for not just the investment policy changes, but to give that review through December 31st.
yeah, I'm kind of open to your suggestions from staff, but I think doing it at least once a year might be good for the other board members to kind of get a sense of it.
The end of the year, when we look at when we could reasonably do it for end of fiscal year, it put us in probably the heart of August.
Yeah,
It's probably not the best time to do the annual review. So I would suggest, since there may not be enough time probably isn't enough time to get ready for February, that we look at the first meeting in March to bring back the calendar 21 results.
I'm fine with that.
And
Yeah,
what
yeah. I'm
and
fine with that too.
I would be looking to both Jason and Joseph and or Ellen to give that presentation, since, staff, we're not experts on the investment aspects of this. We need to manage it, but they're the ones that are really trained and have all the SEC certifications, et cetera.
Yeah, and I would, Jeff, I think that'd be great. And I also think that much as the consultants have done such a good job at this meeting and at previous meetings of just consolidating their comments and not going through each slide, I think that would be much more attractive to the full board. And, you know, sort of skating through it and highlighting the most important points.
Agreed. Okay, we'll work on that. With that, the only other thing I wanted to mention, I know that Sylvia was working on her suggestion from Director Aguilar to try and go ahead and calendar the full year's worth of meetings. So I think the next one we were targeting was sometime mid-May, but I'm just going to say that as a reminder, not for you to do anything, but look for follow-up from Sylvia as appropriate, trying to pin down those future dates. It's helpful for everyone if we can do that, at least for the next one, but ideally for the next 3.
Okay.
I'll send out another email to Director Estrada and Director Aguilar on the proposed schedule. We were trying to find whether it was the 3rd Monday or Tuesday or Thursday or something worked best for the director. So I'll resend that out and wait for the board's responses.
Yeah, I think Vice President Estrada has a much busier calendar than I do, so I would really defer to his choice.
And
And
Sylvia,
I would say that as you report out on this meeting at your next board meeting, it'll give you a little opportunity for your colleagues to chime in on the idea of getting the annual or semi-annual investment performance review. I would suggest annual is appropriate.
okay.
Nothing else? No further presentations, Jeff? Nothing else from anyone else?
Nope, we had a lighter agenda today.
Nice. Okay, we'll go ahead and adjourn the meeting at 10:48. And I'll go ahead and stop the recording. Thank you, everybody.
Thank you, guys.
Thank you all.
Thank you. Take care.
Good presentation. Thank you.